8 companies reporting today, and we're seeing a clear pattern: aggressive restructuring, capital returns, and some real red flags. Sam, let's start with Yamaha Motor, ticker 7272.
Big moves here. Yamaha exited general-purpose engines and generators entirely in December, merged their marine subsidiaries, and consolidated 3 robotics companies under one roof.
Interim profit nearly doubled to 114 billion yen. That's motorcycles in India and ASEAN plus FX tailwinds. But they added Middle East geopolitical risk to procurement. That's new.
Right. They also refinanced 132 billion yen from short to long-term debt and cut non-controlling interests by 24 billion, suggesting minority buyouts. Dividend up to 50 yen from 35.
Base, ticker 4477. They acquired Port Corporation for 882 million yen in April and are actively migrating e-store merchants to Pay.jp to cut payment processing costs.
Revenue up 35%, operating profit up 87%. But what caught my eye? They abolished their poison pill and extended the NDA with activist shareholder Maki through May 2026.
So they're shifting from defensive to acquisitive. Stock options tied to 10 billion yen gross profit targets too. Aggressive.
Ticker 7036. This one's messy. The former managing director CFO embezzled 460 million yen. They're now in remediation mode.
They canceled the guy's life insurance policy for a 16.7 million yen surrender refund. His receivable is still 363 million outstanding. Turned profitable at 67 million, though.
But they suspended the interim dividend. Last year they paid dividends despite massive losses, which was controversial. Now they're prioritizing governance rebuilding.
Ryobi, 5851. Revenue up 2%, but operating profit dropped 25%. 3 segments are struggling simultaneously.
Printing equipment cratered, sales down 38%, swung to a loss. Housing equipment also went to a 185 million loss thanks to CNY appreciation hitting Chinese procurement costs.
But they're pushing hard into gigacasting for EVs. Built a 6,500-ton prototyping machine. New 1.5 billion yen buyback authorized too.
Ticker 519A. Freshly IPO'd on the TSE growth market in March. Sales up 10%, operating profit up 47%, but net income cratered 63% to 59 million yen.
Listing expenses and normalized taxes killed the bottom line. They also launched 2 new products, Workrun and Abo, expanding beyond front office DX.
They converted all preferred shares to common and plan a capital reduction from 370 million to 10 million yen. That's about flexibility.
Juki, 6440. They absorbed 2 subsidiaries directly into the parent, cut 793 employees through voluntary retirement, and liquidated all cross-shareholdings.
Operating profits surged from 92 million to 2.17 billion. The crisis breakthrough project shifting from sales-focused to profit-focused is clearly working.
They even divested their stake in Pegasus, their second-largest shareholder. Aggressive capital efficiency play.
5563. Major red flag. They took a 7.7 billion yen equity method impairment on Pertama Ferroalloys in Malaysia, swinging to a 2.7 billion net loss.
And a battery materials OEM contract for lithium-ion cathodes was partially terminated. That's a growth narrative cracking.
Offset slightly by incineration ash recycling profits up 247%. They also let their takeover defense expire and raised the minimum dividend to 11 yen.
Last one. Mitsubishi Pencil, 7976. They issued 10 billion yen in convertible bonds to Advantage partners with strict covenants and change of control clauses.
Then spent nearly 10 billion on treasury share buybacks in the same period, so they're levering up to buy back stock while bringing in a PE partner.
Sales up 10%, net income up 35%. New Lamy Kuratoga hybrid product too. But that capital structure shift is the real story.
Big theme today. Companies are levering up, buying back stock,
and restructuring aggressively. The question is whether earnings can sustain it.
Watch Yamaha's robotics consolidation and Nippon Denko's battery materials exit. Two very different stories about portfolio discipline. See you tomorrow.